there's a couple things I want to talk about. When we started this program, we came up with the idea it would be called insight. And the reason for the insight is that what we do is we don't react to things. You know, there's a thing on the radio I hear every day, and they say, well, the market went up because of this, or the market went down because of that. And the next day it goes the other direction, and they say it was because of this, or it was because of that. And what we do here in the trust department, we're managing a lot of assets, and we're managing most of them, if not all of them, for long term. So our goal isn't to react to a movement or an event in one day. Our concept and what we think drives what we do correctly is to step back and take every piece as part of an entire puzzle and see what that might be changing, not so much short term, but more medium and long term. And short term to us is within about 6 months. So we don't do a lot of reactionary moves. But I am reminded when I see the market, like today, looks like we'll be up about 350 points at the open today, which is fine. But that doesn't mean anything. We never know what's really going to go. But it always reminds me when I hear the numbers at the end of the day and they say the Dow did this, the Dow did that. It reminds me November 2nd of, it was 1989, I think. I've got my year pretty close, 1978. November 2nd of 1978, Jimmy Carter came out and he made an announcement where he said, today, for the first time in history, the market went up 40 points. And that was a big deal at the time. It was a huge deal, big enough for the president to come out and make a comment on it. And today for us, 40 points is, that means nothing's happened. But you got to keep it in perspective. At that time, the stock market, the Dow Jones average, the number you see every day, which right now is at 26,000. At that time, the Dow Jones average was right around 800. So a move of 40 points was an indication of a 5% increase. And that was a big deal. But to keep that in perspective, today, if we had that kind of movement, we're talking, 5% of almost 30,000 points. It would be a really, really big day. So all of that's relative. That's why when I look at the daily numbers and I hear the daily numbers, I convert that to percentage points. So I want to know where that was. I want to know what the percentage of increase or decrease was. And I want to know what the moving average is as a percentage. That's what means something to us. So with that concept, and that is what we look at insights on market movement, we're going to look at the Dow Jones COVID chart, which will be our first chart this morning. And we show this every week. Here it is coming up in a second. So you see here, the red line is the daily movement. And then the green line, which is a little bit harder to see, that's the 7-day moving average. And then the bright yellow line is a little more relevant. That's the 14-day moving average. So we're looking at the daily movement, as you can see, it's pretty dramatic. It's volatile. You can see a lot of ups and downs. And that goes to my comment when we started that when we're looking at the market, the insight that we use is we don't look at that daily movement very strong. We like to look at more long-term, how's it going? And you'll recall early on when we started this program, we mentioned what type of recovery will we see? Will it be a V or a W or a Nike swoosh, which is what we were predicting at one point. And then Ben Bernanke, you recall we talked about being in a conference with him and he said he would predict a W. If you look over here at the right-hand side, you're gonna see that it's still kind of looking like a Nike swoosh, but we can start to see some indication that it may be a lazy W. And we don't really know, but here's what we're looking at now. We're looking at an increase in COVID-related reports. But again, to keep that in perspective, we don't really know, and I don't know if anybody does, how many of those new cases relate to actual new cases or just an increase in testing. Either one of those is going to lean us one way or the other. So we're still kind of in the middle on determining, are these really new cases or are they cases that existed, but we're just now testing for them? So we're at this point not really ready to predict or ready to call that we're out of this, although we have come back off of our bottoms a significant number. And technically, we're probably really out of what we would call a bear market, but we're still cautious that we may go back into it. So the next factor in all of this, as you stand back and look at the forest, is unemployment. And this is unemployment. Recall last week we had the pretty big jump and everybody was a little bit surprised at that. And that's why, again, why we didn't react, because apparently there was an anomaly. So you can see here the moving average, and the reason that red line looks so flat is because generally the number is about 200,000 a week. And then we had that shoot up, and now it's declined a little bit. And so again, look at the red line. We had an increase in unemployment rate. That moving average has flattened out. And that's a good sign. We were saying we may get up to 20% unemployment. Right now we're at about 14. So the fact that the moving average is flattening out, that's pretty good news. We're not overly excited about it. We see a lot of things coming back. Airlines are starting to bring planes back into service. Hotels are starting to open up. Restaurants are obviously opening up. So more people are going back to work. Then the big question is, how long can we keep that up? Can they stay back at work? Can we continue to function with social distancing and taking our cautionary measures against COVID to keep it from coming back again? So we're looking at right now unemployment. We feel pretty solid, positive about this, that it's flattened out, the rate is flattened out, that our daily or our weekly reports have taken a real dive from that peak. So we're pretty good about that. The other thing that's really, really important right now is housing starts, which is the next chart. The important part about housing charts is the main numbers came in, and see over on the right-hand side, they came in with a bump, and that bump was about 5%. Now, in housing, what you typically see is you see a bump in April and October, and there's some reasons for that. Number one is April, it's a weather related, it's get back to building again. People start looking at moving after school and things like that. In October, you see a bump, typically because people are trying to get the house, what's called under roof, before they do the interior. So they get the house built before they do the inside. So you see a little bit of a budge in October. So here we are seeing a bump in late June, and that could mean a recovery. But again, look at that gray line, and that's the moving average. A little hard to see, but that's the moving average. So we still see a little bit of a dip, and it'll be interesting to see what happens over the next 30 days when the National Association of Home Builders releases their numbers for June and how June does, to see where the numbers go from there. And it'll be interesting to see if that momentum from May continues through the summer and carries us into the fall and gets us to October. And again, remember, October is one of those weather dates where we want to say, after October, we don't expect a lot. So if we could get some momentum going to October, that would be good. Now, the reason this is important to us is because number one is it hires a lot of people. You have a lot of skilled labor into homes. It also moves finances because you have financing for the homes, but it also drives consumer durables and to some extent consumer staples. So when you're building a house, you have to have a lot of things go into it: appliances, lights, the skilled labor I mentioned, electrician, finished carpenters, framers, roofers. All those people are relatively skilled labor, and it requires a lot of employment. That's why the number that I want to see on housing is 1.2 million. That's a nice solid number. And that's what we're looking for. So then we're going to step back a little bit to world markets and keep this relative. And this is actually a really positive chart, because you can see there on the 11th of March of 20, now that wasn't the bottom, but that was close to it. And you can see you have Japan, Germany, United Kingdom, England, Scotland. You can see what those have done. They dropped 20, 29, 16, 28% from basically the end of 2019 to the middle of March, when we were pretty well deep into COVID. And the US markets matched a lot of that. The Dow was down 23.5, 23.4. The NASDAQ was down 17.6, and the S&P was down 21.1. And then over on the right, this was yesterday's close on all of these markets. And you can see that the United States markets, we have three basic exchanges. They're kind of a mix, but you've got that NASDAQ in there, which is up 10.8% since January 1st. But the thing to remember about NASDAQ is very information technology heavy. So when you're looking at NASDAQ, you're looking at a lot of high-tech companies, you're looking at a very high-end industry, and that tends to outperform. It also tends to be a little bit more risky. But even then, if you look at the Dow Jones Industrial Average and the S&P 500, those are still doing better than most of the world markets. And so what I see here, in my view, is a relatively resilient US economy. And it always has been. And now it's a matter of, do we adapt? When the U.S. economy started growing in the 1920s, 1930s, 1940s, it was highly industrial, it was highly manufacturing, and now we've evolved. We're a very heavy service industry. So it was always iffy on how do we recover. But we're actually doing pretty well. The Dow Jones industrial average is down 8.6. And what you got to remember about the Dow Jones is that's 30 stocks. It's a relatively, it is a small sampling, but it's companies that you know, very large companies. Boeing is in there. You've got General Electric was in there for a long, long time. And Johnson & Johnson, ExxonMobil, those are companies that you're familiar with, names who you recognize. So that performance is more of a gauge of the largest companies in the country. Whereas the S&P 500, as the name indicates, it's 500 companies, and that's what's representative there. So what I like about the S&P 500, and what most of us are starting to move from, is instead of using the Dow Jones as our benchmark, we're using the S&P 500 because that's more of a true measure of what companies are doing. It's a nice broad look at companies. So look at that number, and it's down 3.6% for the year, which outpaces all the world markets. And it's a nice sampling. It's a good diversified benchmark, and that's something we really like to see. So if you hear me talk about benchmark, the likelihood is I'm referring to the S&P 500, and that's what I use when I'm looking for decisions on what to do in the market. That's kind of my first stop. NASDAQ is kind of my last. NASDAQ is high risk. If somebody has high risk, that's the place to go, but it's extremely volatile. So here you have that 10.8%, that's attractive. What you need to avoid is running to that to chase performance, and that's not something we'll do. And then miscellaneous factors, as we step back and we try and apply insights to what's going on. This isn't a complete set of what we do, but it's a pretty good view. Over on the up left, look at the US Treasury. You've got a 2 and a 10-year Treasury. When you're doing what we do, one of the things we tell you is when we do any trust account or we're looking at any investment portfolio or we're designing a portfolio, the one thing that we will never do is guarantee anything more than what the 10-year Treasury yield is. And right now, that yield is, I would use the word pitiful. So if you're going to give the government 10 years to grow your money, you're going to grow it at 0.6%. That's not very attractive. And then at housing starts, you can see how we track that. We're actually up over last month. We're significantly down over last year. But when we're looking at this overall, we can see, okay, we're increasing. This is good. The GDP, we talked about that last week. We won't have a GDP number again until mid-July or so, but first quarter was down, which indicates we're solidly in a recession. The concern is going to be what happens to the second quarter. And to be honest, we're probably going to see that number not change a great deal, but I don't think it'll go positive. Here's a number that is a bright side for us. So when we're looking at everything going on, personal savings has actually risen as a percent of income. I would like to see that on that right-hand side where it shows a percentage, I'd like to see that as 10%. As someone who has been in investments for a long, long time, one of the things that we've always taught that is if you save 10% of your income for all of your life, when you retire, you will have more money than you ever had in your life to live on. And mathematically, that proves true. So ideally, I'd like to see that at 10%. 7% isn't bad. It's better than most have been. We've had years where it's been less than 2. So to see that rising during these times is an extremely, to me, positive look. Because what we do know is while the consumer price index has kind of been waffling, we do know that we're spending more on groceries. We're spending more certainly on protein, beef, chicken, fish. We're spending more on everything except gasoline is kind of moderated. So to know that our biggest expense, which is food, has gone up at the grocery stores, it's also, I think, a factor we have to consider is we're eating out less. And eating out can be a huge piece of a family's budget. And that may be part of what's causing this increase in savings, but it's a good thing for me to see. And then on the right-hand side, you see inflation, how we're tracking that. And from a pure economic point of view, you really need to see inflation somewhere between 2.5% and 3.5%. And there's a long explanation for that, but that helps the economy grow. It helps contributions to Social Security grow. And we need that as the generations continue to age. But what we're seeing now is our current year-to-date inflation is 0.6%. Our forecast for 2020 is 2.25%. And that's given us a 10-year average of about 1.7%. That's not awesome. It's not great. It's not too exciting. It's a little concerning. But one of the reasons it's concerning, looking down line, is that with that inflation rate, a lot of human resources departments base their evaluation of increases, merit increases, and raises on the rate of inflation. Certainly, Social Security depends on that. And if we see that number drop and continue to drop, our concern is that personal income will decline. Social Security won't raise to match, and it's going to miss that over on the left side where I was talking about the increase in groceries, the increase in everyday living expenses. So that's a little bit of concern. But again, what I talked about at first, we don't want to react to anything immediately. So right now, while 2020 year to date is 0.6%, we're in month 5, not quite 6. We're not quite halfway through the year. COVID has had a huge impact. So we still need to step back and see what that's going to do. If it rises up to 1%, I'd probably be happy with that. And then if I could see that 2021 go up a little bit to get up to maybe 2.75 or 3%, that would be a little bit more comforting, knowing that, yes, things are costing more, but we also know that personal income would go up. And then if personal income goes up, maybe over there on the left-hand side, we see that personal savings continue to go up. And that would be great. If I could see that number at 10, see inflation at 3, see GDP at about 2.5, that would be wonderful. What's blank over here is unemployment. I've left that blank for now because I think that's still kind of an elusive number until we figure out why that report a week ago was so positive. But we're still looking at roughly 14% unemployment for now. And it appears, as we talked about a minute ago, it appears that that's leveling off, that's good news. So that is where we are. We're at 8:18. I've gone on a little bit long. I apologize for that. We'll be back next week. If you have questions, please send them in to mvaughan, VAUGHN, at firstoptionbank.com. Mallory has been producing today from behind the big blue First Option Financial curtain. She'll be here with us again next week, and then we will be off on July 3rd. And once again, I express my appreciation. All of you have joined us. We hope this is worthwhile. And if you want to refer your friends to Facebook, it'll be recorded on Facebook for visuals later on. Thanks for joining us. Have a great week. Great Father's Day. Thanks.